A private equity fund pays $4 million of carried interest to the GP. 3 years later, the GP is asked to return 1.5 million. Was the GP penalized? No. And if you describe clawback as a punishment in a senior private equity interview, you may be explaining the outcome without understanding the mechanism. In this video, we will break down why clawback exists, how excess carry arises, when exposure is measured, and how to answer the question in an interview. Let us begin with the principle. Carried interest is the GP's agreed share of fund profits calculated under the waterfall in the LPA. A clawback protects the final economics of that agreement. It requires the GP or the relevant carry recipients to return carry received above the amount ultimately earned. So, clawback is not a fine for poor performance, it is a true up. Now, let us run the numbers. Assume the fund has an early successful exit and generates $20 million of profit. Under a simplified 20% carry arrangement, $4 million is distributed as carry. At that point, everything appears correct, but the fund still owns other investments. Later, one of them generates a loss of $7.5 million. The fund's cumulative profit falls from 20 million to 12.5 million. 20% of 12.5 million is 2.5 million, but the GP has already received 4 million. The difference, 1.5 million, is excess carry. That 1.5 million may need to be returned so the final split between the LPs and the GP matches the LPA. The important question is, how could carry be paid before final fund performance was known? The answer is the distribution waterfall. Under a whole of fund waterfall, the GP generally receives carry only after investors have recovered the required amounts across the fund. This reduces the risk of carry being distributed too early. Under a deal by deal waterfall, carry may be distributed after successful individual exits while other investments remain unrealized. That can accelerate carry, but it can also create greater clawback exposure if later investments underperform. This is why early winners followed by later losses are the classic clawback story. Now, when is clawback calculated? The final obligation is usually determined near fund termination when the cumulative results of the fund are known. However, exposure should not remain invisible until the final day. Depending on the LPA, the fund or manager may perform interim clawback tests, often using a hypothetical liquidation. This means assuming the remaining investments were sold at their current values, running the waterfall again, and comparing the carry already distributed with the carry currently supportable. If distributed carry is higher, there may be potential clawback exposure. But remember, potential exposure is not always the same as a presently payable final clawback. The LPA controls the trigger, timing, calculation, tax treatment, caps, and repayment mechanics. Some structures also hold part of the carry in escrow to reduce the risk that the money cannot be recovered later. Here is another senior level point. Do not assume that clawback automatically means one standard journal entry. First, identify the reporting entity. Are you accounting for the fund, the GP, the management company, or a carry vehicle? The economic obligation may be related, but the accounting presentation can differ. For the manager or carry recipient, a probable repayment obligation may result in a liability, depending on the governing agreement and applicable accounting policy. For the fund, the treatment must be assessed based on the fund's rights under the LPA and the relevant reporting framework. So, in an interview, never rush into a debit and credit before understanding the structure. Now, imagine the interviewer asks, is a clawback a penalty on the GP? A strong answer would be no. A clawback is a contractual true-up mechanism. It requires the GP or carry recipients to return carried interest distributed above their final entitlement, so cumulative distributions match the waterfall in the LPA. The exposure often arises when carry is paid on early winners and later losses reduce overall fund profits. Final clawback is usually determined near fund termination, although interim exposure may be tested earlier depending on the agreement. That answer explains the purpose, cause, timing, and governing document. The phrase to remember is simple. Clawback does not punish the GP for losing money. It prevents the GP from keeping more carry than it ultimately earned. If this explanation helped you understand the mechanics, not just memorize the definition, like the video and subscribe to the Fund Desk for more private equity and fund accounting interview explainers.